is John Graves, author of The 7% Solution. You can afford a comfortable retirement. Also editor of theretirementjournal.com. Today we're going to talk about advanced insurance strategies. Let's discuss a few different ideas from a wide variety of choices. Would you like to ensure that your heirs receive their full inheritance outside of taxes? Would you like to provide liquidity in an illiquid business environment? Would you like to provide aid to the youngest members of your multi-generational family? Is the community of very significant interest to you? Do you wish to provide protection for an important person in your business? Do you wish to provide protection for a family member who may have gone astray? Each of these answers can be arrived at with the proper use of an advanced life insurance strategy. Let's examine each. In the event of a husband and wife passing away, if their estate exceeds a certain amount, it becomes eligible for federal estate tax. That federal estate tax, different from income tax, begins at $6 million in 2011. Any amounts over that are immediately taxed at 40%, very quickly rising to 55%. If you happen to be wealthy enough for that to be a problem for your heirs, an irrevocable life insurance trust may be a simple, straightforward answer to the tax problem. You would have an attorney draft the ILIT, the Irrevocable Life Insurance Trust, and that insurance trust would have a trustee. The trustee would use assets inside of the trust for a variety of things, one of which may be the application for life insurance on you or your spouse. The trust itself has what's called crummy powers, which means that the beneficiaries of the trust may request withdrawal of capital once a year. They never do that. And upon the expiration of those powers, the trustee then uses capital in the trust to pay the annual premium. Upon you and your spouse's demise, the trust itself receives the death benefit proceeds and may use it for any number of reasons, including possibly the payment of any estate taxes or death taxes due on your estate. The ILIT may also use the proceeds by holding them aside to help assist or protect an individual family member who may be challenged economically, may have a substance abuse problem, may not have filed taxes for several years. In other words, it allows you to literally reach beyond the grave and provide some level of financial assistance to a wayward member of the family without giving them a very large sum of money. A second use for the ILIT. In the event that you own a business with a partner or partners, in the possibility of your partner passing away, you probably don't want to be in business with her spouse. The ownership of her interest in the business is an illiquid asset. There typically is no way for you to transfer that other than pay her cash for the proceeds. If your business has been successful, you're probably not going to have a significant amount of money put aside to buy her out. Thus, the company might apply for and purchase life insurance on each of your lives. The company would bonus you the monies for the annual life insurance premiums to each of you. You would pay taxes on that bonus and use the net proceeds to actually pay for the insurance contracts. And if your business partner passed away, you would receive the death benefit proceeds. You would have a contract drawn up, which is called a wait and see buy-sell contract, that gives you first right of refusal to buy all of the shares of the firm from your partner's estate, from his spouse. You've got the proceeds in the life insurance death benefit, and you give her those proceeds, in exchange for which she gives you the shares in the company. On the side, you have a agreed upon formula to identify the value of the business. You and your partner have revisited that formula every couple of years so that his estate, his spouse, feels well compensated. Thus, you've turned an illiquid asset into a liquid asset, and you have also avoided having to be in business partnership with someone who may not be familiar with the intricacies of your successful business. You may feel very strongly about a particular charity. Your kids and grandkids may not feel so strongly. You might, in this case, use a life insurance trust to pay for the premiums for an insurance contract on your life. The trust would have the specific intention upon your death and the receipt of those death benefit proceeds to put those monies either lump sum as a gift to the charity or to put them aside and pay monies to the charity over a period of time. You've now benefited the charity and yet not taken any monies away from the inheritance of your family. Everyone is made good. Finally, you may have a colleague in your business who provides makes a valuable contribution to the firm. It might be yourself, your business partner, a key person in the firm. The business might apply for and pay the annual premium on a life insurance contract on this key person. And in this case, we're using a permanent insurance contract, and we're filling this contract up full of money. We're willfully putting as much money as possible into the contract because the deferred earnings on the insurance contract, the savings account, will be used to pay, ideally, for the retirement benefits that you're going to pay out to this individual, or if they're disabled, pay out a disability income stream for a period of time. So the business is able to use business dollars to preferentially treat a few individual key employees for their own benefit in exchange for their superior contribution to the firm. The beauty of life insurance is leverage. You typically pay very little in exchange for receiving a significant amount in the form of a death benefit. Thank you.